Welcome to MacroHive Conversations with Bilal Hafiz. MacroHive uses natural and artificial intelligence to educate investors and provide actionable insights for all markets, from rates to FX to commodities. For our latest insights, visit macrohive.com. Before I start my conversation with this episode's guest, I have 3 requests. First, please make sure to subscribe to this podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave some nice feedback and let your friends know about the show. My second request is that you sign up to our free weekly newsletter that contains market insights and unlocked content. You can sign up for that at macrohive.com. Finally, and my third request is that if you are a professional or institutional investor, do get in touch with me. We have a very high-octane strategy and analytics offering that includes access to our world-class strategy team, market views, AI models, and much, much more. You can email me at bilal@macrohive.com, or you can message me on Bloomberg for more details. Now, onto this episode's guest, Marc Rubinstein. Marc is author of Net Interest, a leading weekly newsletter on the world of finance. Before this, Marc spent 10 years at leading hedge fund Lansdowne Partners, where he was a partner and portfolio manager. This was after he spent time on the sell side working for Barclays Investment Bank, Schroders, and then Credit Suisse, where he was head of the European Bank's research team. Now, on to our conversation. So greetings and welcome, Marc. It's fantastic to have you back on the podcast show.
Thanks, Bilal. Great to be here.
Now, one thing I didn't ask you the last time you were on was something about your approach to looking at markets and the financial sector, which is one of your areas of specialty. So you've been on the sell side, on the buy side, and now for many years you've been an independent analyst. And so, what can you see today that you weren't able to see before in your previous guises?
So there are clear differences between, as you said, I moved from the sell side initially to the buy side. There are clear fundamental differences between those roles. What I often say about that shift is that sell side is one dimensional. It's about, is it going to go up or is it going to go down? I'm talking about stocks. Whereas possibly a more important question on the buy side is position sizing. So it's 2 dimensions, being the stock idea, but also to a degree conviction. It's not only conviction, there are some other factors that filter into that, but position sizing is incredibly important. The shift to being kind of an independent commentator, observer, sitting on the outside looking in is incredibly liberating. I'm not restricted anymore, as I was on the sell side, to a specific universe of coverage. Even on the buy side, there are kind of mandates. There are firms. I think when I look at markets, a lot of what's going on can be explained by mandates. Firms that are only allowed to invest in issues which have a credit rating. Firms that are only allowed to invest in investment grade and can't invest in sub-investment grade. Those that can invest in equities. You look, for example, at the stock market, the stock strategy, previously called MicroStrategy. The only way to explain the valuation, it's come down from its highs, but the only way to explain the valuation of that is that Bitcoin or crypto broadly wasn't in the mandate of some in the investment community. Stocks are, and the founder, CEO, Michael Saylor was exploiting that. So there was a kind of a mandate arbitrage. So there's still a restriction. It's still not completely liberating working on the buy side. Now I'm completely liberated. I can look at anything I want. I can look at it for as long as I like. And what that's done is it's kind of reintroduced to me the importance of history. So when I was kind of managing money, there was inevitably fires to fight. There was always something going on. I would look at recent history in order to form a view, but it was difficult to justify the time invested going back into longer, deeper history. And what I've realized is that every stock has a story. There's, in many cases, an institutional memory in the company, and to uncover that institutional memory, it can be quite useful to go back in time. And similarly, when looking at markets more broadly, there's nothing new under the sun. And that's true around innovations, and it's true around business cycles. And I'm sure we'll go on and talk about it, but it's true around within business cycles, boom and bust as well. And having an understanding of some of the features that occurred in prior cycles are just incredibly useful for understanding the future.
No, that's a great characterization of your, and I can see this in your work, in your output that we'll talk about how people can get hold of it, net interest, which is a really good product. Now, speaking of these booms and busts and so on, there's been an intense focus at the moment around this AI boom. Now, you've been around the block a few times. If you don't mind me saying, .com, GFC, all of these crises and such. So, and then as you say, you're an ardent student of history as well. So, how would you situate, this current AI story? What's the context we should think about here?
Well, so there's been a lot written about what analogies are applicable to the current AI cycle. People have gone as far back as to look at railroads in the 19th century, both in England and in the United States. People have looked at the telco bubble in 1999-2000, which interestingly was a confluence of two quite distinct bubbles, really. The dot-com bubble, which is the more famous one that people talk about, but underlying that, the telecom bubble, which exploded at pretty much at the same time. And they've looked at AI, and I suppose the thread that goes through all of them is infrastructure, is the build out of expensive infrastructure, of capital expenditure by a few companies, in all cases, without an understanding as to ultimately where the value would go, where the short-term revenues were not sufficient to fund the expenditure. It went sour in the case of railroads. It went sour in the case of telecoms. Of the kind of the takeaway that historians and economists and people not burned by these episodes has been consistently that society was better off for these bubbles because railroads were laid that were still being used up to 100 years later, that telco lines were put down that were still being used later. And so similarly today, and there's been a number of books written, one by Bern Hobart with Tobias Huber, wrote a book recently called Boom, about the benefits, societal benefits of booms, that they incentivize funding in, say, moonshot innovations, but innovations that don't necessarily justify the investment upfront through traditional channels, which have ultimate benefits. So those are the analogies. A lot of discussion about that right now. And yeah, I mean, look, we can talk about some of the details in a sec, but no one really knows. I think the consensus I've picked up is that it looks like all the conditions are there for it to be a bubble. But we don't know how far we are through it. And a lot of money was made by equity investors in 99 and 2000. Famously, Alan Greenspan spoke about irrational exuberance back in October of 96. So significant amount of time before the peak.
And one thing you've talked about in some of your work is not necessarily 1929, which is often a common reference point people have for sort of depression and the more extreme outcomes, but rather 1907. So why have you brought up 1907 in your work?
Yeah, 1907 is interesting. It's ill remembered because it was overshadowed by 1929. But it was actually where J.P. Morgan, the man, earned his stripes. So famously, and it was almost a blueprint for the resolution to the LTCM blow-up in 1998, he got everybody into a room involved in Wall Street, into a room in Wall Street, in order to hash out a bailout for, at the time, it was one specific trust company. The reason why I'm talking about it now is because these trust companies that built up huge market presence in New York in 1906 and the 20 years in the run up to that are not too dissimilar. They were non-banks. They grew through a regulatory arbitrage whereby they were able to lend longer term. There were certain other restrictions that they weren't tied to, unlike the banks, that enabled them to grow. And that is not too dissimilar from the growth we're seeing right now and have done since the 2008 financial crisis of non-banks, be it private credit, be it asset management companies more broadly. Recent data suggests that non-banks now have about a 50% share of financial assets in the US, up from 40% coming out of the financial crisis. And the amount of regulation that has constrained banks and bank lending over the past 15 years has led to this big discrepancy in terms of growth. Interestingly, Scott Bessent, US Treasury Secretary, was saying recently, US regulatory authorities have unwound some of that and are on a campaign to unwind further some of those restrictions around banks. But he said, just empirically, the growth in non-banks is in and of itself an indication that banks have been too heavily restricted, something bank CEOs have talked about as well. So that's kind of the analogy. It's a crisis that was seeded by non-banks that weren't as highly regulated as banks and had grown market share as a result of that to a degree that became systemically dangerous, because behind the scenes, banks were lending to them. So in 1907, trust companies were funding their balance sheets through bank lines. Biggest growth area of bank lending year to date in the US explains on a net basis all of bank lending in the US year to date is lending to non-banks.
So, I mean, is that a worrying sign for you, do you think?
Well, typically, so my very simple rule of thumb is in financial services, particularly on the lending side, growth is always a source of concern. Excessive, super normal growth is always a source of concern. It's something that regulators took to heart post-financial crisis. BIS in Switzerland now monitor credit as a share of GDP, and they look for, they can warn market participants there's not much they can do to mitigate it, but it's a measure that they track and they post in their publications. So the concern generally around private credit is that it has grown. Recently, some cockroaches have scuffled out from underneath the sofa. It's a term Warren Buffett has used before. Jamie Dimon mobilized it recently, talking about first brands and various other, in some cases, fraud-related defaults. There was a period just when banks went through their earnings recently, followed by the non-bank alternative asset managers, where they were pointing at each other as to where this exposure lay and who fundamentally underwrote it. But the fact is their interest rates aren't as low as they were up until 2022. But the fact is there has been a 15-year long search for yield. And that creates demand for product, for credit product, ultimately. It creates a incentive to loosen underwriting standards. And when one half of the financial universe is not as regulated as the other half, there is a danger that it will be sourced in that half. And so it is a concern. Is it systemic? That's difficult to answer because the benefits of private credit have been, one, less retail involvement. Everybody who funds private credit is historically an institution. Actually, that's not the case now. That the alternative managers are using the wealth channel in order to source more funds for private credit and selling evergreen funds down that channel to high net worth individuals. But historically, less retail involvement. There wasn't the capacity for there to be a run on the intermediary because funding was matched. There was a mini run on Blackstone real estate evergreen fund in 2023. Probably wasn't a run because there were various processes in place to mitigate it. Gates were put up and had always been marketed that these gates were in existence, such that if more than 5% of the NAV was looking to redeem, then it would be gated and redemptions would be met on a first come first served basis. So that risk isn't there, but there's a lot of opacity. And again, another story that's emerged recently is the idea of kind of ratings arbitrage, that ratings companies, something we saw in 2007, ratings companies aren't being as diligent on their issuance of ratings in some pockets of private credit. And so it's indicative of maybe a more lax kind of underwriting standard. So it's not as simple as in the banking sector where liquidity presents a risk. But all of these features together still create, I think, some pockets of risk, particularly when you don't really know, given the opacity, how much leverage is built up.
And it seems like, one of the issues from the recent cockroaches, so to speak, was the fact that there was some, I know how you want to term it, like double dipping around collateral, or collateral was used multiple times. Something like that. I mean, is there sort of ex ante any way of like capturing that somehow, or is there only an ex post thing that we find out that that's happening?
Well, so then they all go back and re-underwrite and go and visit. It's interesting, through the bankruptcy of First Brands, one of the creditors, through the bankruptcy filings, has issued a report, which is in the public domain, which includes photographs. They went to visit, one of their representatives went to visit various warehouses, in one case down in Mexico, and took this photographic evidence of collateral being there. So many of the lenders will re-underwrite. They'll go back and have a look. But again, like I said up front, nothing new under the sun. This very famously, there was a huge, American Express was involved in a huge fraud historically, known as the Great Salad Oil Swindle, where
That's a good name.
It's a great name, where they were warehousing vats of vegetable oil, and the representative from Amex would go along, check that there was vegetable oil in the vats. But of course, what the supplier was doing was they were filling the vat 90% with water, bit of oil on the top, and it was a complete fraud. It's famous today because the stock tanked. It was a significant issue for American Express back in the 1960s, and Warren Buffett took a stake. He took advantage of that, dropping the stock price, and took his first stake, which turned out to be a phenomenally successful investment. So I guess in that case, it was a single cockroach. But
I mean, is there a way of somehow tracking fraud, so you can kind of somehow look if it's escalating or not, or
Well, so it's cyclical, right? Famously, J.K. Galbraith talks about the bezel
Yeah.
as a measure of the amount of embezzlement in the economy. And he makes the point that when there's a rising tide and valuations are going up, it's just not visible. And that it's only when, and we saw this in 2008, Madoff floated to the surface in 2008 when asset valuations came down. We saw other frauds emerge then. Similarly, in 2001 with Enron, WorldCom, and so on. So it's a really interesting topic. I don't know if individually it's possible to identify. I think in some cases when I think it's impossible. I think it's difficult to identify individually. Actually, there's another newsletter writer, Doomberg, who has quite a following, writes about energy, wrote a piece this week suggesting that when industries are pushed to the margin of society, so whether it's for various reasons, whether it's oil and gas or because of climate, or whether it's tobacco, then often kind of mainstream buyers don't want to touch these industries. And so it kind of lends itself, those industries then lend themselves to greater propensity for fraudsters to get involved. And in financial services, so my sector, as you know, my sector is finance. I follow financial services. There is a greater propensity for fraud in financial services because, again, famously, the old saying, the bank robber was caught. I forget his name, but very famous American bank robber was caught, and he was asked by a journalist, "Why do you keep robbing banks?" And he said, "That's where the money is." So there is a propensity for greater fraud in financial services. Interestingly, possibly in industries that are pushed to the margin, but it's a constant. It just emerges, as Galbraith said, at times when we see market corrections.
And earlier you mentioned non-bank sector in relation to private credit. If we look on the on kind of the sell side, so to speak, you've written about Jane Street and their phenomenal trading revenue that they've been capturing, more than Goldman Sachs, I think, of late, and they have much less employees. I mean, what does that tell us about the state of the financial sector and technology in the future?
Yeah, it's an interesting point. So you're right. So in the first half of the year, they did over $17 billion of revenue, which is more than Goldman did in its trading business, roughly the same as JP Morgan in theirs, on, as you say, fewer personnel, which suggests that technology is a big factor. There's a UK-based private company called XTX, which is hugely successful at principal trading using algorithms fundamentally and other techniques. Interestingly, what they would argue is that, I mean, these aren't high frequency traders. This isn't flash boys. That trade's been done. This is more about know-how. And XTX is building a data center up in Iceland, I think. They're one of the largest owners outside of the hyperscalers of GPUs, and they're using these tools in order to get a trading edge, just as historically high frequency traders used co-location and various microwave technologies in order to exploit faster speeds. So technology is one. I think regulation absolutely is another. Again, it's the same theme as the one we were just talking about. Jane Street fundamentally operates with less regulation than Goldman Sachs and JP Morgan, and that's been the case since the financial crisis. So I think those two factors. And through regulation, they've got more freedom to operate as a principal. But increasingly, we had this saying before the financial crisis that one didn't know if one was kind of Goldman Sachs' customer or their counterparty. I think post-financial crisis, that debate has been resolved, but that's not the case for the likes of Jane Street anymore, or Citadel, which operate businesses which may be distinct, but they operate as principal, but also as a market maker.
And, I'm also thinking in relation to technology that we're also seeing exchanges like LSEG and so on trying to position themselves more as data companies or analytics companies rather than exchanges. So there seems to also be this drive in the financial sector for various different players in the market to kind of say they aren't brokers or traders, rather they're data providers. What are your thoughts on that?
Yeah, it's slightly. So do you know how much London Stock Exchange makes of their revenues now from trading?
No.
I think it's like 3%. It's immaterial. And it's the same ICE, which owns the New York Stock Exchange. It's the same there. And it's a slightly different theme. What they've done is they've integrated various different components of the value chain. So they do depending on the market, they might do settlement, they might do they'll do clearing, they'll provide data, they'll do the listings on the equity side. But there's a whole range of services that they offer. ICE is actually interesting because it's recently taken a stake in a prediction market, which is really interesting. They've built up stakes in the mortgage business. But the point I'm making is, so they span lots of areas of the value chain, and what they strategically decided was to actually commoditize the trading piece. That more of the value comes from data, and then they just absolutely just commoditize the trading piece. And that was a strategic insight that they had a number of years ago. And you're right, they've all gone down. They've all gone into data.
And if you look at their valuations, their trading multiples, they're they're higher than, say, the investment banks, for example, or the brokers, it seems.
Yeah. Again, I think that's been, and their share, their kind of market footprint is greater now than it was pre-crisis. The crisis was a long time ago, it was 15 years ago, but these things take a long time to work their way through the system. One of the shifts in value from investment banks to exchanges that occurred post-crisis was the requirement by regulators for clearing to occur in certain markets. So previously, banks made a lot of money on OTC trading, and a lot of that in credit and other markets went, interest rates went on exchange, and the exchanges were able to capture value through their clearing houses, which most of them own.
And another technology people have talked about, or banks have talked about, to differing levels of skepticism or support, is blockchain, where some banks have embraced it to say everything will be on blockchain, or blockchain will be a big part of the sort of tracking and the infrastructure. Other banks are more skeptical. What's your take on that?
Yeah, no, I think it's really interesting. I think they've always, to be fair, I think, the kind of cliche from bankers going back even 2016 was they would say, we don't like Bitcoin, but we like blockchain. And they kind of always wanted to divorce the two technologies. However, iteration one was that they would compile their own private blockchain, that they would operate a private blockchain, which many of them launched and tried to do. Recently, since the whole shift post the change in the administration in the US at the beginning of this year, at the beginning of 2025, since the kind of shift in perception around crypto broadly, that has also changed. And now iteration two is that the banks are are developing projects on public blockchains. So JP Morgan runs its private blockchain, but recently it launched a JP Morgan deposit on a layer 2 platform operated by Coinbase, called Base. So and increasingly there's a number of innovations as well, because the issue here is that the underlying technology is Ethereum in many of these cases, which many banks and financial institutions argue doesn't lend itself to financial transactions. And one of the reasons is, public is fine, but it shouldn't be that public. Maybe it should be an opt-in. There should be a facility to be able to opt in to whether it's public or not. Other issues as well around speed, around kind of processing fees not being fixed, but being linked to capacity on the platform at any one time. And if you're kind of transferring large amounts of money, you kind of want to know what the fee is going to be before you transact and how long it's going to take before you transact. So various factors that are looking to be resolved through many, it's kind of a classic network thing where initially they all think that they will develop their own platform. And so Coinbase wants to launch one. There are a couple of other specialist companies and startup companies which are trying to, there's a company that recently IPO'd called Figure, which operates one. Stripe wants to launch one for payments. So use case blockchains fundamentally for single-use blockchains for financial services. A number of those are being rolled out, but it's got buy-in. All of the banks, even the most skeptical bankers like Jamie Dimon at JP Morgan, Bank of America, in their earnings calls earlier this year, were all embracing this technology and have projects on the go. JP Morgan has a whole outfit internally called Connexus, which employs 200 people plus. So they are taking it seriously.
And you mentioned IPOs, and when we look at the IPO market of fintech companies, many who IPO'd a number of years ago, many of them are still trading underwater, from their kind of elevated launches. So, is this a case of like when we try to put tech in, we get caught up in these waves and they don't end up performing? Why they perform so poorly?
Yeah, so the 2021 vintage has performed poorly. There are some exceptions like Robinhood, which I think as we're speaking is actually the best performer in the S&P 500 year to date. It entered the S&P 500 this year. But most of the others, maybe it's kind of like a venture type of return profile. One or two do extremely well. Most of the others do poorly. But I think it just reflected the mood at the time, or reflected the environment at the time, which was there was a retail demand for stocks, which bled into institutional demand for stocks. And equally, and sellers will exploit that, as they always will. Look, I think a lot in finance can be explained by thinking about supply and demand, and the same is true in the IPO market. And when the ducks are quacking, you feed them, and that was true in 2021. It kind of there's been a window in 2025, and you'll see companies exploit that. They might not be ready to IPO. They might never have been ready to IPO, but they'll exploit that. They'll exploit that. Again, Warren Buffett, I think, always said, wouldn't touch IPOs.
Yep. No, that's wise words from him, at least in this case. And,
right.
I guess listening to you, we've talked about like Jane Street, LSEG and blockchain and so on. So, if you were to set up a new financial institution today, I mean, what would you set up and what would it look like given what we've talked about, given the state of the world, technology, regulation, things like that? I mean, what would be optimal structure of a financial institution, or what type of what corner of the financial market would you target?
It's a good question. I think if you look at an organization like Revolut, I was walking through Canary Wharf, where you're based recently, and I think it was only in the past month that they have opened their global headquarters in Canary Wharf. So nestled between the HSBC Tower, the Citigroup Tower, and others, there is Reuters, there is Revolut, and which is interesting. I think what they're doing is they're exploiting their technology first. They're exploiting this idea that it's difficult for banks to pass on cost benefits to consumers when they've yet to decommission their legacy cost base. Many cases of financial services where through M&A, cost bases and tech platforms get knitted together badly. Get knitted together badly, and so the ability to come build a new system from scratch, difficult to make it future-proof. I think again, one of the interesting thing about financial services is you do see these cycles. You know, PayPal was the new thing once, and that has lost share to on the processing side or the merchant acquiring side to Stripe and Adyen. So even the new thing ceases to be the new thing in a very fast developing business, particularly when the free cash flow isn't there to the extent it is for a traditional tech company, high margin, high gross margin tech company, which gives it an ability to reinvent itself. So I think that's interesting. I think consumer financial services is very interesting. You know, when you look at Bank of America hosted an investor day recently, the stock has lagged JP Morgan since the financial crisis, but it's on some measures the largest bank in the US. On others, it's JP Morgan. But in consumer, it's a really interesting business that has potential to cut costs further going forward as more of their business migrates online. But then there are other businesses around it. It's too big a conglomerate in order for that one business to kind of shine through in the valuation. And a startup like Revolut able to focus exclusively on consumer very efficiently and to do it across markets. The risk is regulation. So at some point the regulators will look more closely at a fledgling fintech. And my example here has been consumer, but it's true. I guess that focus, that scrutiny comes earlier on the institutional side. And that can cause some problems because there is a material trade-off in financial services. I said earlier, you know, growth isn't necessarily a good thing as my rule of thumb. And that would be anathema in the tech space, where as long as the funding is there, I guess, growth is just good. It's not the case in financials. And so there's this trade-off between showing the numbers in order to get the funding and showing high growth, and then kind of basically running up against regulatory and compliance failings because the systems haven't been able to catch up with that rate of growth.
No, there's a great observations there. You did mention the challenge some of these bigger institutions have around revamping their tech stacks, you know, because as you said, they've knitted together lots of legacy tech stacks and there's just the path dependence there. Are there any, large institutions that have actually done a good job in transforming their technology and actually getting over the hump?
It's always difficult for an outsider to know. The greatest resource within financial services, greatest resource that I have is the post-mortem reports that authorities will will commission following some kind of bust. Because what's interesting about them is they tell you how the sausage is made in a way that you had no idea as an outsider sitting in the audience at an investor day, listening to the chief technology officer tell you how wonderful the technology is. So, a great example is Archegos in the case of Credit Suisse, one of the scandals that ultimately brought down Credit Suisse, and how communication lines weren't there internally, how the technology wasn't up to scratch internally, to an extent the outsiders didn't know. So look, I don't know. It seems like JP Morgan is good. But then actually you hear a story about them acquiring this fintech, Frank, where they didn't do their due diligence. It's kind of small, and it doesn't strictly answer the question, but it's a chink in the armor, possibly. But from a technology perspective, just the amount they spent, and Bank of America too. Bank of America spent over $100 billion on technology, which is a phenomenal number in the past 10 years. So this year they're spending about $11 billion. And it actually feeds into your question as well. Of that 11 billion, only 4 billion is new stuff. 7 billion is maintaining the legacy systems. So there is a significant cost associated with that. But they've got now the cash flow, certainly since interest rates have gone up, big beneficiary for depository institutions to fund that kind of 4 billion a year in new tech spend. So, I can't underwrite that. I don't know if it's good spend or bad spend, but it kind of looks okay.
And just to round off this sort of, overall sort of discussion, what are the things you're most excited about in the sector in the next, say, 12 months, and what are you most worried about?
So I wouldn't use the word excited, but I'm cognizant of the opportunities that may emerge from the swing back in regulation that the banks may benefit from. So the deregulation that's taking place in the banking sector. I think there's a lot going on in AI, which could benefit some financial institutions. So again, I'll give you a Bank of America example. It's top of mind because they hosted this investor day I mentioned not that long ago, but they have a virtual financial assistant called Erica, which does like 2 million inquiries per day. And they claim that to replicate that, they'd need 11,000 people in a call center. So the benefits, this wasn't like they would have hired the 11,000 and they're not firing 11,000, but they've created a service at the cost so the benefit here accrues to the customer rather than to them in the initial stages. But going forward, the benefits of AI broadly, both on the institutional side and the retail side in financial services, should be quite high. A little bit scary as well. I've got sons who will be entering the job market quite soon. And traditionally in finance, as in other industries, you would have entered at the bottom of the pyramid and done work, some of which AI can now replicate, in order to learn and in order to provide the stepping stone to positions higher up in the pyramid. If that bottom of the pyramid is being disintermediated by AI, then that's a concern for future leadership within the industry, but it's a challenge that these firms will have to navigate. So I'm excited. So deregulation, AI. I'm really watching what's going on in AI financing, because if it is a bubble, that will create opportunity for some players and losses for others. It's something to watch very carefully. Similarly, in private credit, we've spoken about it. Opportunities there. Yeah.
Okay, that's great. And I noticed that you are a big reader. Are there any books that you would recommend that you read recently that you thought were particularly good?
Yeah, actually, I've got two in front of me. One is, it's kind of right now, it's like a New York Times bestseller, so it's not particularly original, but it's 1929 by Andrew Ross Sorkin. I saw Andrew about a week or two ago at an event where he was talking about the book. Interestingly, he began it in like 2016. Some incredible research. He began it in 2016. In fact, there's nothing in the book that paints any kind of analogy with the present day whatsoever. And yet, in order to sell the book, he's being forced to at least draw on some parallels. So I think every book review about it, every interview he does on a podcast or live about it starts with, interesting timing. Particularly as he hasn't waited for the 100-year anniversary. Interesting timing. Do you see signs of a bubble today? And I think, we spoke about 1907. We spoke about 2000. I think if there's one thing to draw on from 1929, it was retail engagement in the market. Which was rampant then, much as it is now. And then the other book, which was just released a couple of weeks ago, is The Land Trap by Mike Bird. Mike Bird is the Wall Street contributor to The Economist. So he writes many of the articles on finance in The Economist that people will have read. And he looks at, he calls it a history of the world's oldest asset. I'm interested in asset classes, how they emerge, how they evolve, the booms and the busts, and the interrelationships between them, and land, and maybe property more generally. It's a bit fuzzy how he distinguishes between land and real estate, but land, in many cases, is the lion's share of value in real estate. And so he talks about the history of that, which is deeply fascinating for somebody who looks at financial services, where real estate is the single biggest source of collateral.
No, that's great. Great recommendations. I'll look out for those books. And finally, what's the best way for people to follow your work?
Well, so my Substack is called Net Interest, all one word, netinterest.co. It's on the Substack platform. You can find me there. You can find me on, don't use X/Twitter much anymore. So Substack probably is the best place to find me.
No, that's fantastic. And I definitely recommend people to subscribe to Net Interest. I mean, I learn a lot from it. And once again, thanks for the conversation, and also good luck with all the future work that you're doing.
Thanks. Likewise, Bilal. Thanks. Great talking to you.
Great.
Thanks for listening to this episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'll be very, very grateful. And of course, sign up for our free newsletter at macrohive.com. And this podcast is not intended to be investment research, nor does it constitute financial, economic, legal, tax, or accounting advice. This podcast is provided for information purposes only and does not constitute an offer or solicitation to purchase or sell any financial instruments. The contents of this podcast are not based on your individual circumstances and should not be relied upon as an assessment of suitability for you of a particular product, security, or transaction. The information in this podcast is based on generally available information and although obtained from sources believed by MacroHive to be reliable, its accuracy and completeness are not guaranteed. Past performance is not a guarantee or indication of future results. Third-party opinions expressed in this podcast are solely those of the speaker and do not represent the views of MacroHive, BGC Group, or any of its affiliates. And this podcast may not be copied or distributed in whole or in part without the express written consent of MacroHive. All rights are reserved.